If gold really reaches $4,000 an ounce, it will not simply be another record-breaking headline. It could become one of the biggest financial warnings of our generation. Most people would celebrate the price. Experienced investors would ask a very different question. What forced gold to climb that high in the first place? Because history shows that gold rarely explodes without a powerful reason. Tonight we break down the warning nobody wants to hear and why this could change everything for your money, your savings, and your future. For years, gold has been viewed as the ultimate safe haven. Whenever investors lose confidence in paper assets, they often turn toward physical gold. But the story unfolding today feels different. We are not just seeing another short-term rally driven by market excitement. We are watching several long-term forces begin to align at the same time. Inflation concerns have not completely disappeared. Government debt continues climbing. Central banks are buying gold at one of the fastest rates in modern history. Global trade relationships continue changing. Investors are becoming increasingly cautious about what comes next. These are not isolated events. Together they are creating an environment where many analysts are beginning to ask a question that once seemed impossible. Could $4,000 gold actually become reality? Only a few years ago, even discussing gold above $3,000 sounded unrealistic. Yet markets have repeatedly surprised investors throughout history. Every major financial shift first appeared impossible before eventually becoming accepted as the new normal. The same happened with interest rates, housing prices, stock market valuations, and government debt. Markets have a habit of moving much further than most people expect, especially when powerful economic trends remain in place for several years. The first reason behind growing optimism for gold is the changing direction of central banks around the world. Instead of reducing gold reserves, many countries continue adding to them. These purchases are not driven by short-term speculation. Central banks generally invest with decades in mind rather than weeks or months. Their decisions often reflect concerns about long-term financial stability, currency, diversification, and economic resilience. When official institutions steadily accumulate gold, many private investors begin paying closer attention because these buyers usually focus on preserving wealth rather than chasing quick profits. As gold attracts increasing attention, another powerful force is quietly strengthening the long-term outlook. Government debt continues expanding across many of the world's largest economies. Every year, governments borrow more money to finance spending, infrastructure, social programs, and economic support. While borrowing can help economies during difficult periods, excessive debt eventually creates difficult choices. Governments may raise taxes, reduce spending, increase borrowing, or allow inflation to slowly reduce the real value of debt over time. None of these options are painless, and financial markets closely monitor every development. This is one reason why investors often become more interested in hard assets during periods of rising debt. Gold cannot be printed by any government. It cannot be created with the push of a button, like digital currency. Its supply grows slowly through mining, which gives it scarcity that has protected wealth for thousands of years. When confidence in paper assets weakens, gold often becomes one of the first places investors look for stability. Inflation remains another important piece of this puzzle. Even though inflation has cooled from its highest levels, many consumers continue paying significantly higher prices than they did only a few years ago. Food, housing, insurance, healthcare, transportation, and everyday expenses remain elevated in many parts of the world. The purchasing power of money has changed. Many families now realize that keeping cash alone may not fully protect long-term wealth. The Federal Reserve continues balancing one of the most difficult challenges in modern economic history. Policymakers want inflation to move lower without causing a severe recession. If interest rates stay high for too long, economic growth could slow sharply. If rates fall too quickly, inflation could accelerate once again. This balancing act creates uncertainty, and uncertainty has traditionally supported demand for precious metals. Interest rates also influence another important market relationship. When rates rise, the US dollar often becomes stronger because higher yields attract global investment. A stronger dollar can place temporary pressure on gold prices, but if investors begin expecting future rate cuts, the dollar may weaken, allowing gold to gain momentum. Markets constantly adjust these expectations after every inflation report, employment release, and Federal Reserve meeting. At the same time, global geopolitical uncertainty continues shaping investor psychology. Trade disputes, regional conflicts, supply chain disruptions, and shifting international alliances all increase demand for assets that are viewed as stores of value. Gold has historically benefited during periods when investors become uncertain about the future. It does not require confidence in one government, one company, or one currency. That independence remains one of its greatest strengths. Another trend receiving enormous attention involves the growing movement toward diversification away from traditional reserve currencies. Several countries have openly discussed increasing the use of local currencies for international trade while simultaneously expanding their precious metals reserves. Whether these efforts completely reshape the global financial system remains uncertain, but they demonstrate that many governments are actively preparing for a more diversified financial future. Institutional investors are also paying closer attention. Large investment firms, pension funds, and wealth managers increasingly recognize gold as an effective portfolio diversifier during periods of elevated uncertainty. Even relatively small increases in institutional allocation can generate significant demand, because these organizations manage trillions of dollars in assets. Exchange-traded funds backed by physical gold continue providing investors with easier access than ever before. During periods of strong investor confidence, these funds often experience large inflows which increase overall market demand. While ETF activity can fluctuate over shorter periods, the long-term trend has made precious metals investing far more accessible to ordinary investors around the world. Mining supply presents another challenge that receives far less public attention. Discovering new high-quality gold deposits has become increasingly difficult. Many of the largest and most productive mines have already been operating for decades. New discoveries often require years of exploration, environmental approval, financing, and construction before production even begins. This means supply cannot rapidly increase simply because prices move higher. Production costs have also risen significantly. Mining companies now face higher labor costs, higher energy prices, more expensive equipment, and stricter environmental requirements. As production becomes more costly, higher gold prices may eventually be needed to justify new mining projects. This supply limitation could become an important long-term support for the market if demand continues expanding. Perhaps the most overlooked factor is investor psychology. Financial markets often move through emotional cycles. During periods of optimism, many investors ignore defensive assets and focus on rapid growth. Later, when uncertainty returns, those same investors rush toward safety, often after prices have already moved significantly higher. Gold has repeatedly benefited from these emotional shifts throughout history. If gold were to reach $4,000, it would likely reflect far more than simple investor excitement. It could signal persistent inflation concerns, slowing economic growth, weakening confidence in paper currencies, elevated geopolitical uncertainty, or a combination of several major global trends occurring simultaneously. The price itself would not be the real story. The conditions creating that price would deserve far greater attention. This is why experienced investors often focus less on predicting exact price targets and more on understanding the forces driving long-term demand. Markets rarely move because of one headline. They move because multiple trends gradually reinforce each other until momentum becomes impossible to ignore. If gold continues advancing toward $4,000, investors will face an important decision. Some will assume the move has gone too far and wait for a major correction. Others will believe the long-term trend is only beginning. History suggests that both optimism and caution deserve consideration because no market rises forever and no major trend lasts without periods of volatility. Gold has experienced sharp pullbacks even during powerful bull markets. Those temporary declines often test investor confidence before the larger trend resumes. Understanding this reality helps investors avoid emotional decisions based only on short-term price movements. Long-term investing has always required patience, discipline, and a willingness to focus on fundamentals instead of daily headlines. Silver could also become one of the biggest stories if gold continues climbing. Historically, silver has often followed gold during major precious metals bull markets, but it has frequently moved even faster once investor confidence begins expanding. Because the silver market is much smaller, relatively modest increases in investment demand can produce significant price swings. This is one reason many experienced precious metals investors closely monitor both markets instead of focusing only on gold. Industrial demand creates another important advantage for silver. Unlike gold, silver plays a critical role in modern technology. Solar panels, electric vehicles, artificial intelligence, infrastructure, semiconductor manufacturing, medical equipment, and advanced electronics all require significant amounts of silver. As the global economy continues investing in new technology, these industries could provide strong long-term support for silver demand, regardless of short-term investment sentiment. If gold reaches $4,000 while industrial demand for silver remains strong, many analysts believe the gold-to-silver ratio could become one of the most important indicators to watch. Throughout history, periods of strong gold performance have often been followed by powerful silver rallies once investors recognize the changing market environment. Although history never guarantees future results, these relationships continue attracting attention from professional investors around the world. Another factor that deserves careful attention is the health of the global economy. If economic growth slows while inflation remains elevated, markets could face a difficult environment often described as stagflation. During previous periods of stagflation, precious metals frequently performed well because investors searched for assets capable of preserving purchasing power, while traditional investments struggled under economic pressure. Currency markets may also play a major role in determining where gold moves next. The US dollar remains the world's dominant reserve currency, but its value constantly changes based on interest rates, economic performance, government policy, and investor confidence. A weaker dollar has historically provided support for higher gold prices, while a stronger dollar can temporarily limit gains. Watching currency trends remains essential for anyone following precious metals. Many investors also underestimate the importance of confidence. Financial systems operate because people trust currencies, banks, governments, and institutions. When that confidence remains strong, investors often favor stocks, bonds, and business investment. When confidence begins weakening, demand for hard assets frequently increases. Gold has earned its reputation over thousands of years because it exists outside the promises of governments and financial institutions. This does not mean every investor should move all of their money into precious metals. Diversification remains one of the most important principles in successful investing. Different assets perform well during different economic environments. Stocks may lead during periods of strong growth. Bonds may provide income during stable conditions. Precious metals often perform best when uncertainty becomes the dominant market theme. Building a balanced portfolio has historically reduced overall risk while allowing investors to benefit from different market cycles. The coming months will likely provide several important clues. Inflation reports, employment data, manufacturing activity, consumer spending, Federal Reserve meetings, and central bank purchasing trends will all influence investor expectations. Every new economic report has the potential to shift market sentiment because expectations often matter just as much as the data itself. Investors should also continue monitoring physical demand around the world. Retail coin sales, bullion purchases, exchange-traded fund flows, and central bank acquisitions all provide valuable insight into whether long-term demand remains healthy. Strong physical buying often creates a more durable foundation than speculative trading alone. Perhaps the biggest warning nobody wants to hear is this. If gold truly reaches $4,000, the celebration may be overshadowed by the economic conditions that made such a price possible. A world where gold trades at that level could also be a world experiencing elevated inflation, slower growth, higher debt, greater financial uncertainty, and continued geopolitical tension. The higher price would represent not only opportunity, but also a signal that deeper economic challenges remain unresolved. That is why experienced investors rarely focus only on the number itself. They ask what the market is trying to communicate. Every major price movement tells a story. Gold has always reflected confidence, fear, expectations, and changing economic realities. Listening to those signals often provides more value than simply watching the latest price chart. Whether gold reaches $4,000 next year or several years from now remains impossible to predict with certainty. Markets will continue reacting to new information, changing policies, investor psychology, and global events. What seems increasingly clear is that the forces supporting precious metals remain stronger than many expected only a short time ago. Central bank buying continues, government debt remains high, inflation risks have not completely disappeared, geopolitical uncertainty continues shaping financial markets, supply growth remains limited. These long-term trends deserve careful attention from every investor. The future will belong to those who stay informed, remain disciplined, and understand the bigger picture instead of reacting to every daily headline. Gold has protected wealth through wars, financial crises, inflationary periods, and economic transformations for thousands of years. Whether the next great chapter takes gold to $4,000 or beyond, one thing remains certain. The conversation surrounding precious metals is becoming more important than ever. If you enjoyed this analysis, make sure you hit the like button, subscribe to Silver and Gold Watch, and turn on notifications so you never miss our latest updates on gold-silver inflation, the Federal Reserve Central Bank, buying, and the biggest developments shaping the global precious metals market. Now tell us what you think in the comments. Do you believe gold will reach $4,000 during the next major bull market, or do you think another surprise is waiting for investors before that happens? Thank you for watching, and we will see you in the next video.